Hello and welcome to India Decides, the FII View with me, Tanveer Gill. We're back with another edition of the show where we put the spotlight on India, given the global backdrop and, of course, the key local event risk in elections. My guest today on the show is Sam Mahtani, Director, Emerging Market Equities at FNC Asset Management. Sam joins me all the way from London and he runs an active India portfolio. Sam, great to have you on the show. Thanks very much for taking out the time to speak with us. Let me begin by asking you about your India view. Now, at the start of the year, you expected that the Indian market would return 15% for 2014. We've already done about 10%, adjusting for currency gains. Does that mean that most of the rally is in the price? Or could this be a year of supernormal returns for the Indian market?
Well, we could see a higher return than we forecast for this year. And obviously, the overall return does depend on the outcome of the elections next month. And clearly, if Mr. Modi comes back in or comes into power with a government, the market could continue to perform quite strongly into that event. So this year we could see higher returns than our original forecast, which we made at the beginning of this year.
Right, Sam, is the view among FIIs changing a bit given the election event, with new scenarios being talked about in India? From a month ago when many investors saw this rally as unprecedented, now it seems more of the same, pre-election rally with the market correcting post-elections, irrespective of the outcome. Is that your view too?
Well, it's very difficult to make a definitive forecast, obviously, on what's going to happen in the election at this juncture. I mean, obviously, the market seems to be very excited about and anticipating Mr. Modi to come in with the support of a coalition government. And I would say that the market has discounted that scenario probably 70 to 80%. So there is obviously a high level of optimism in the market at the moment, with obviously, as I mentioned, expectations running very high that Mr. Modi will come in with forming a government with the BJP and a coalition.
Right, Sam, I know this is an unlikely scenario, but what happens if the BJP doesn't come to power? What is it that you're accounting for then from the market?
Well, if Mr. Modi doesn't come into power, there's clearly going to be a setback to the market and a correction, because obviously, the market has been running with the view that Mr. Modi would come in. So, we would expect to see quite a severe short-term setback to the market, when the election results are announced.
Right. As a fund manager, how are you seeing the targets put out by brokerages like Goldman Sachs, CLSA in anticipation of the election result? Targets of 7,600, 8,800 put out of late. Can the market see those levels this year, you think?
Well, some of the forecasts, could be a little bit optimistic. As I mentioned right at the beginning of the interview, it really depends on the outcome of the elections. If the elections do, pan out the way the market's anticipating, we could see higher returns from the Indian market here on in, over the next several months. So obviously, it's a binary event. Obviously, with the potentially the elections clearly dictating how the market moves in over the next kind of 3 months.
So what are the scenarios that you're working with post-election? If we have a BJP-led government or otherwise, what do you expect the Indian economy to do once the election event is out of the way?
Well, we anticipate a recovery in the Indian economy, regardless of whichever kind of political party comes back into power. We think the economy is kind of troughing along, at a trough of around the current kind of growth rates of 4.7% of GDP, and we think given some of the momentum that's been building up in terms of the growth in the rural areas and just the improvement in some of the confidence levels, we think the economy can bounce back gradually to around sort of 5.5% GDP growth. Now, the pace of that recovery will be dictated by the kind of makeup of the political scenario after the elections, and obviously if Mr. Modi does come into power, then we think the pace of the recovery will be a lot stronger.
But from a macro standpoint, what do you expect? Do you expect rates to stay higher as the yield suggests, or could they come off by year end?
No, we anticipate rates to stay around these levels, so we'd expect the Reserve Bank of India to continue to maintain quite a tight monetary stance through this year, given they're focused now on the CPI and the fact that the CPI still is at quite high levels, relative to other emerging markets and developed markets. So we would expect the RBI to continue to be, quite tight in terms of its monetary policy this year.
What about growth then? What are you expecting in terms of GDP growth? Is also earnings growth for FY15?
Well, as I mentioned, GDP growth, we expect a very modest recovery in GDP growth from the sort of trough levels we've seen this year. In terms of earnings growth, on average, over the next couple of years, we're expecting sort of double-digit earnings growth around sort of 13–14%. Obviously, the growth will be a bit lower this year, but it will recover next year. So obviously, that puts the market on around about 14.5–15 times 2015 PE at the moment.
How do you view the Indian market then from a valuation perspective? Currently 14–15 times FY15 earnings. How much elasticity would you give the market from a valuation perspective, as historically 15 times plus is seen as expensive for India, or at least getting into that expensive range?
Yeah, I mean, I think at the moment the overall market is, definitely trading around fair value. Clearly, as I mentioned, the political outcome will have quite a big impact on the overall market. From a bottom-up perspective, we're still very happy with the investments we have in India, and we still see upside to some of the key stocks we own in India, like TCS and ICICI Bank and HDFC Bank. So from a bottom-up perspective, for the companies we focus on, the high-quality companies, we still see further upside in those particular companies.
Sam, in addition to the $10 billion that we've seen coming from FIIs this year, there's talk that the average India allocation, which stands at 6% benchmark to the MSCI EM index, could go up to 16–20% post-elections among foreign funds, if the outcome, of course, is favorable. Is that the sense that you're getting as well? Will funds reallocate higher to India by that margin?
No, I think that sounds quite optimistic to me. I wouldn't expect the average FII allocation to go to that kind of level. I think that looks pretty optimistic to me.
Okay, let's talk about your investments in India, and you run an active India portfolio. Sector-wise, I mean, what have you been doing in the market over the last 3 months? What has been your portfolio strategy in this up move that we've seen for the market?
Well, we've actually done very little in the last 3 months. We started the year with a very large overweight in India, in a mixture of sectors and focused very much on the high quality companies we like, and we've stuck with that strategy through the last 3 months, and still remain very happy with the companies we own. So we've done very little in terms of activity over the last 3 months in this through this rally.
What's the strategy with IT then, Sam? Is it time to buy IT post a correction, or use every rise as an opportunity to book profits? Because the start of the year, at least the first month, IT stocks saw a good return. I see that you have a big overweight on TCS, and then of course in the pecking order you have HCL Tech also in your top 10 holdings. Give us a rationale behind your preference among the two, and also your view on Infosys post the revenue earnings warning given out by the management. How do you place Infosys in your view on technology?
Well, we still continue to believe that TCS in particular is the highest quality and the best company to own in the IT sector, and it's been a company we've backed for several years, and we continue to believe that they have the capability to drive further growth, increase their market share, and also deliver strong growth for the next 3 to 5 years. So on a sort of 3 to 5 year view, we're still very happy with the TCS story. With Infosys, we're still very cautious on the continuing sort of management reorganization that's taking place there. We've seen obviously over the last several quarters, the last few years, there has been a lot of volatility in the quarterly earnings, and again, that was backed up by their recent warning about the profits for this quarter. So we would still be very cautious on Infosys, and much prefer TCS on a 3 to 5 year view.
Also, Sam, what have you made of the Sun Pharma Ranbaxy deal? As a shareholder of Sun Pharma, do you concur with the management's vision and the brokerage upgrades that have come in for Sun Pharma? Largely expecting the pedigree of Sun Pharma to make things right as far as turning around Ranbaxy is concerned.
We do. We have been, again, a shareholder in Sun for a few years. We clearly know that they are good at making acquisitions, turning around businesses. The Ranbaxy deal looks strategically very kind of good for them in terms of providing them with synergies in India and access to some new emerging markets, which they previously did not have access to. So, as long as the Sun management can deal with the regulatory issues that Ranbaxy has in the US, which is going to be the biggest challenge of this deal, we think it can definitely add value to Sun shareholders.
There was also, of course, news on L&T recently, and you hold that stock in your portfolio as well, where the management spoke about writing off 10% of the total order book. Now, that was pretty much on expected lines, but do you see this as a trend for cap goods as there is delay in executing orders?
Well, obviously that's related to some of their slower moving orders, which have been impacted by the sort of the state of the economy, the last year, sort of 18 months. So that wasn't really a big surprise. We still think there will be a sort of very modest improvement in the outlook for some of the kind of infrastructure and capital goods areas. But obviously a lot of that the outlook for the sector will really be dependent on the new government and the policies they take to try and sort of kickstart the economy again. And so we'll have to sort of wait and watch and see what's announced.
As far as financials are concerned, Sam, you are largely invested in private banks. What about PSU banks, especially, the price to book valuation comparison that is drawn? They're looking at sub one time price to book 1 year forward, which seem like attractive levels for a lot of these PSU names. SBI, I see getting added in a lot of portfolios. What's the view on SBI? What's the view on PSU banks, as also NBFCs like IDFC post the banking license?
Well, we've been very focused and very happy with the private sector banks we own. We're very happy with the strategies they've articulated and the credit quality they've got. We'd still be cautious on the public sector banks and the NBFCs. We still believe that there's a very good credit penetration story in India, and the best way to play that is through ICICI Bank and HDFC Bank, and we've backed those managements for several years, and we continue to believe they're the right managements to back going forward.
What about the consumer story in India? For ITC, HUL, which have been laggards again, if the market goes up from here, how much of that rally would be led by these names?
Well, clearly the excitement has been in other sectors, but we still like HLL and ITC, but in particular ITC we still think is a very good and strong play on several long-term themes in India, like the improvement in income levels, the growth in rural incomes, and the switch from BDs to cigarettes. So ITC is still very much one of our preferred, large cap consumer names in India, and a company we again very confidently believe will grow, its earnings on a double-digit basis for several years ahead.
Also, what's your perspective on the energy space now? Oil and marketing companies particularly, which have shown good momentum, and ONGC, Reliance Industries. From a value perspective, how are you placing your view on this sector?
Generally very cautious on the energy sector as a whole, partly because we're not very optimistic on the outlook for refining margins going forward, and also because of just government interference, obviously with the state-run OMCs. It's very difficult to forecast those companies, given the subsidy bill is really a kind of moving kind of target. So with that kind of backdrop, we're very cautious on those types of public sector names, the HPCLs and the BPCLs of this world.
Sam, let's talk about your EM view then. What are FIIs feeling about the EM versus DM trade? Do you think the tilt is shifting in a meaningful manner for emerging markets now? Are you seeing the signs of that happen? Given the fact that there are increasing sound bites on the US rally being overdone.
Well, we are seeing some very tentative signs that there could be a switch back into emerging markets. I mean, the latest fund flow data that came out last week suggested for the first time, I think in about 12 months, that we've had net flows back into emerging markets. As I mentioned, after something like 52 weeks of consecutive outflows. So The kind of switch out of developing markets into developed markets does seem to be very well played out. It's a theme which we think has kind of played out fairly well now, and once investors focus back on some of the sort of exciting kind of bottom-up opportunities we can get in emerging markets, I think that there could be a further kind of shift back into emerging markets. Particularly if we see a more stable kind of macro outlook and better growth, which is what we're expecting in India.
Recent data, of course, Sam, suggests that EM ETFs are seeing a lot of inflows. What about long-only funds such as yourself? Where is the interest more within the emerging market pack? Is it more in EM-dedicated funds, BRIC-dedicated funds, or Asia funds?
I think as a whole, the recent sort of initial kind of trickle of money back into EMs has gone back into emerging markets generally. So it's not gone into kind of the regional areas like Asia or Latin America. The focus has been back into general emerging market funds, be it ETFs or long-only managers. And I think that's really the way forward. If people or investors do look to allocate back, they'll probably look to allocate to the asset class as a whole rather than picking a region or a particular country.
And what about emerging market currencies? Your view on the rupee is, of course, that the upside is capped there, but what's your broad view on EM currencies?
I think at this level the rupee is trading at fair value, given that we've had quite a big level of appreciation over the last few months. Clearly it was oversold, given the levels it went to sort of in September last year. But at this level we think the rupee is definitely trading towards our sort of fair value, and it doesn't look cheap or expensive at this level.
And finally, Sam, what risk, to your mind, can spook the market sentiment at this point globally? Whether it's tapering, potential tightening, inflation in emerging markets, growth slowdown, political uncertainty, etc. A lot of the risk seems to be in the price. What can be negative for the market then?
Well, I think obviously for India the number one risk is if the BJP and its coalition partners don't come in. That's clearly the number one short-term risk. I think apart from that, there is obviously always the risk of a more aggressive tightening of US monetary policy, which can obviously spook investors in the very short term and lead to sort of higher levels of risk aversion. I think they would be the two sort of principal risks out there at the moment.
Well, Sam, thanks very much for joining us and giving us your perspective on the markets. Really appreciate your views. With that, we come to the end of this edition of India Decides, the FII View. We leave you with a slice of opinion on the Indian markets in lieu of the big local risk, that is elections.
I think we might see a slowing down of flows through this period of elections. And then after the elections, it will be a factor of how well the policies come out and whether the electoral results meet expectations or not, and the kind of economic program that the new government embarks on. If you look at the valuations for Indian markets, they've always been higher as compared to several other parts of the emerging world. I guess partly attributable to the fact that Indian demographics are so strong that it gives you a much longer and a much more sustained trajectory of economic growth if the economic policies are correct. Currently, the stocks which stand out in our analytical framework, which involves valuations, fundamentals, and earnings momentum, a lot of them belong to discretionaries, energy, and some defensive sectors as well. Well, you need to have a mix of exposure to all sectors. You need to pick the right stocks which will deliver both during good and bad environments. So it's not that you need to walk out of a sector which is facing temporary headwinds completely. Having said that, in our regional portfolios, we have reduced our exposure to some of the export sectors in India, especially the IT sector, given the fact that some of the other sectors, stocks, especially in banking, consumer discretionary, energy, seem to be showing a better combination of valuations, fundamentals, and relative momentum.
In India as well, I think both what's happened on the current account is very positive, and it looks now that we might be entering an earnings upgrade cycle, having been in an earnings downgrade cycle for some time. We're finding opportunities to invest in companies where we think the fundamentals are good and the valuations are okay, and that's in a broad range of sectors. Actually, it's in the export area, but it's also in the domestic demand area, and even now in looking for opportunities in some of the domestic cyclicals. There's no substitute for bottom-up equity research in our view, and that's what we concentrate on doing at Fidelity, and we're finding opportunities in both camps. So we wouldn't advocate a wholesale departure from the expensive growth area into the cheap value area. Irrespective of what's happening in the macro environment in India, always seem to be able to find good investment opportunities among the very broad range of companies in India. There are some very well-run businesses in India that trade on acceptable valuations in our views.